Hi, everyone. Welcome to another KE Report webinar. I'm your host, Corey Fleck. This webinar is being produced in conjunction with Focus Communications, and we are featuring TriStar Gold. I am chatting with the president and CEO, Nick Appleyard. TriStar is traded on the TSX Venture Exchange under the symbol TSG and on the OTCQX under the symbol TSGZF. Now, this is going to be a series of webinars that I am going to host with TriStar Gold. We're going to keep these a bit shorter in format, and we're going to keep them very much focused on a couple key catalysts. The main catalyst coming up being the pre-feasibility study. Now, this webinar is going to be focused on some of the optimization avenues for this pre-feasibility study that the company is looking at. To bring everybody up to speed, TriStar Gold does hold the Castelo de Sonhos project in Brazil. The company already has a PEA and then a PFS that was released October 2021. Resource standing at about 2.5 million ounces. Now, Nick, you're going to run with the presentation for about the first 15 minutes here. We will have a Q&A period at the tail end of the presentation. And I will also interject some questions throughout that presentation. You can all send your questions to us through the chat function and the Q&A function within this webinar. If you're having any trouble using those, you can also email me directly, fleck@kereport.com. Now, Nick, take us away, and everybody, please send in your questions.
Thanks very much, Corey. Welcome, everybody, today. All right, let's just jump straight into it. I think most people know the story a little bit who are on today. Obviously, disclaimer, we're talking about some forward-looking statements. We're talking about our plans moving forward. I'll just flick through some of the generic slides. Obviously, the board of directors company structure hasn't changed. We've still got about $4.5 million in the bank and moving forward very well. Yeah, not much changed on there, so I'm going to move it through.
In terms of the $4 million, Nick, that'll take you through this PFS, right?
Well, the PFS is complete. What we're doing is we're just looking at optimizers and tweaks and where we can make improvements on it. Yeah.
Got it.
Just in case there is people new on board here, project is located in central Brazil in the southern border of Pará state. It is 100% controlled by TriStar. It's a paleoplacer, very similar geologically to Tarqua and Jacobina. It's a great location for mining. It's close to infrastructure. It's in farming country. It's got very simple, very clean metallurgy. And it's been going really well. Development's been moving rapidly for the last 5 or 6 years. We would probably go, it says on the slide here, 10 times, but I think we're closer to nearly 9 or 10 times growth now. And we have the pre-feasibility study complete, and we still believe there's a lot of upside to go. As I mentioned, we did complete the pre-feasibility study in October. We filed the report in early December last year. Very simple project. Open pits, conventional tailings dam. Yeah, 2 phases of mining, really. I think that's the important thing that came out of it. Phase 1 is Esperanza South, which is the real heart of the projects where the better grades are. 1.2, 1.3 grams a ton average over 6 years there. Whereas Esperanza Center and East are the sort of satellite deposits, 0.8, 0.9 of a gram there. So you make less money there, so obviously we do that last. But it is worth keeping that in mind later on, because as I talk about what we're doing with the optimization, it may come back to phase 1, phase 2 parameters as well. Just the highlights of the PFS. So I do want to make sure everyone's understanding what we're doing here is we're not trying to make the PFS work. We've got this base we're nice and confident on. We can grind to a certain size. We can build a certain size plant. We can get the recovery, and we can make this work as shown here on the screen. 1.4 million ounces reserves, 120,000 ounces a year, all-in sustaining at $900 an ounce. So we're confident that's a good number. What we're trying to do is improve on that. And there's always improvements. I mean, this isn't something new we're doing. I can promise you, assuming this mine goes ahead as planned, there's going to be guys like us or a team like us working on improving this up until almost the day it closes. I mean, you're constantly doing this. Just trying to give people a little bit of an insight into what happens on these projects as you work on it. This slide I left in for just to show, this is sort of what we're looking at, what can happen here. And the other thing that is important on this slide, the PFS was done at $1,550 gold. Gold today is $1,900.
Just over 1900, yeah.
Yeah. So, you're a long way from the gold price that we did our analysis at, which means a whole lot of things can change because everything's interrelated. And as gold price goes up, your costs are going to go up, your revenues are going to go up, your cutoff grade theoretically will go down. Material that was potentially waste now becomes ore, and everything can change. So a lot of moving parts, and so you always do want to be doing these optimization and understanding what's going to happen as prices change.
Nick, when you talk about prices changing, then what about CapEx? You showed the CapEx on the last slide of, I believe, 260 million.
Yeah.
Any comments on, we all hear about inflation, how impacted this build could be?
No, well, the one, if it's a good thing, I think a thing we can take away from this is the fact that our cost estimate, our CapEx estimate, was a sort of mid-year 2021 estimate. So at least a good portion of the inflation that maybe you could say is COVID driven is already into our numbers. Obviously, there's probably another year's inflation now. So I think, compared to companies that maybe had a pre-2020 CapEx number, we're going to look high because we've got that inflation in there already. There's always potential for more. In my experience, as we've seen gold prices sort of really move, and you've seen the industry move in the past, you'll never get gold prices going up and costs staying even. I've never seen that personally. So, you're always going to expect it, but your margins generally do increase. And that's the bit to look at. But saying that on these sensitivities and the optimizations we're looking at, we do also analyze, okay, if TriStar is going to do this on our own and capital's hard to look at, is there a soft start option, maybe a lower CapEx option and things like that? So we do absolutely look at that.
Okay, thanks.
So the way I'm going to do this, what we're doing right now is we're just really looking at throughput through the plant, but it does obviously impact everything because that means output from the mine as well. And I want to make it slightly educational in nature. I know most people, have never seen this level of detail, so hopefully it makes sense to people. But what we did when we published our PFS, we had recoveries based on 98% metallurgical recovery, which is very, very good. And that was, if we grind to 105 microns, we use 1 gram per liter cyanide, and it's in that cyanide for, in the tanks in the CIL plant for 36 hours. And we're pretty confident with that. Never 100% confident, but we're pretty confident that'll work. That's pretty good. But what we look at is each of these components, the grind size, the cyanide strength, and the residence time, that they're interacting with each other, but they each have quite a different impact on costs. So the grind size, grinding down, there's some impact on CapEx in that if you decide to grind a bit coarser, but the real impact on that is in your operating cost because there's a lot of power to grind rock down to powder. And a lot of grinding media gets used. So there's a lot of cost in operating to do that. Same with the cyanide strength. You're using chemicals and then you're paying to destroy them because you don't want to put anything dangerous out into your tailings dam. So there's quite a big operating cost component to the cyanide strength that you use. The residence time is more of a CapEx thing. That's how many tanks you're going to build, and those tanks are expensive. So it's this sort of triumvirate of 3 components that we're looking at when we optimize the plant throughput, and that's what we're talking about here a little bit today.
So are these 3 factors, are these all fairly average for, let's say, a PFS? Obviously, they can vary a lot, but when you talk about maybe average for a lot of different development stories, how does the grind size relate? How does the cyanide concentrate?
Okay, I think our 105 micron grind would be considered average to slightly fine grind. A lot of the ones you see in Nevada are much, much finer. Sometimes you'll go a bit coarser, but once you start getting double that, it's getting very coarse. So it's in the average range. Again, cyanide solution, again, we're probably at the very low end of that because we have such a clean ore. We don't have to have high strength cyanide, which is a real benefit to us. Residence time, it's probably middle of the range as far in my experience. Again, I should have explained at the beginning, I'm not a metallurgist, I'm a geologist. This is just based on 20 years experience. The residence time, yeah, would seem fairly normal to me.
Okay. So none of this stuff is extreme on the
No, there's nothing extreme. I mean, the metallurgically, this deposit is very, very easy. It is absolutely the easiest one I've ever worked on. So we are looking sort of from a good situation to a better situation is where we're trying to go. Okay. So when we talk about grind size, the curve on the left here is the first thing we generate. We'll take one sample, one grade. We composite a sample, make 20, 30 kilograms of sample, all as much as we can at a single grade. You can never do it perfectly, but it's one composite sample that's blended up. And you take 4 parts out of it, grind them to the different grind size, 75, 105, 150, 250 microns, and then see what recoveries you get for that. And you get a curve like you see on the left here. Castello is unusual because you always expect as you go to coarser grind size, you are exposing less gold to the cyanide solution and your recovery is going to drop. And you can see that from 105 to 150 to 250 microns on this sample, that the recovery dropped. At Castello, we do have a strange thing happening where when we go really fine to 75 and beyond, we start to lose recovery again. And there's a few theories on that. I haven't got a hard solution, but we do notice that a bit. If we try and go finer on this, you start to lose gold again. So it's probably, my feeling is that we're exposing free gold and then it's starting to stick to each other and clump up together and then you're losing recovery. But what we do is we take that curve, but the recovery isn't everything. It's really a factor of, to get that recovery, how much money is it going to cost us? So we look at all the incremental costs, put them into a quite complicated spreadsheet, and then we end up with a curve you see on the right here, which obviously is run at 3 different gold prices or whatever gold prices we want, to show what's the cost of achieving those grind sizes. And this is where I want you to look. I mean, on here we show, and this is one particular sample, that 105 micron and 150 are pretty well equivalent. The results start to favor the coarser grind at higher gold prices here because it's like more throughput is at a discounted rate, so you're going to make more money. It doesn't always go that way, but this is sort of what we look at. But what is important is here we took the 105 because we had a lot more data than just this one point. We were consistent. We knew we could get that. But a lot of the data tells us that 105 microns from a financial point of view is going to be as good or in some cases even better because you can take into account CapEx as well. So the other 2 components of this are the cyanide strength and how long it's in the tanks for. Really how many tanks you have there and it's moving through each one, how long that process takes. So this is a sample we ran just very recently. And you can see the blue line is the cyanide strength we have as our base case scenario. The orange line is a slightly weaker cyanide solution. And if you sort of project both lines out to the right, they're going to end up at the same point. It's just the weaker solution takes longer to get there. And if you think we had 36-hour residence time in our PFS, that blue line is pretty well recovered. Everything is getting pretty well flat. The orange line hasn't. So the orange line wouldn't work for us. It's saying you've got to be in that. If you want to be this strength, you need to be in the tanks longer. And it's sort of based on this. This sample here was actually, I know it was 2.5 grams a ton. So it was a high grade sample. But we do expect some high grade to be going through the plant like this. So for that reason, we've settled on the 1 gram per liter cyanide because if you don't, this tells us we will be losing, a decent percentage of our gold when we put high grade material through the plant.
So Nick, are you doing a lot of these tests with the different gold grades, some of the higher grade, some of the lower grade? Will it transfer over that way?
Well, the truth is when we do these tests, there's always a little bit of guesswork and there's always a bit of luck in predicting the grade that we want, because however much work the geologists put into selecting samples at the right grade, it's not until they get it to the laboratory and do some quite, a detailed analysis of the grade of the whole sample, we know what actual grade went in there. So like I said, this sample was picked from the mine and was supposed to be, we thought it was going to be 1.2, 1.3 grams a ton, which is about the average for average grade at Esperanza South. That's what this was targeted at. But it came in just over 2.5 grams a ton. So we've got that data point now, but it's interesting, it tells us stuff, but it's not representative of most of the deposit. So what we're doing now is we're sending lower grade material through, and in general, and it is a general rule that the high grade material is going to recover pretty well. Time being an issue, make sure you have it in there for long enough. The concern is what happens quite often at lower grades, but yes, so this one has been done at higher grade, and you'll see shortly now that we are looking at some lower grade samples now to do the same work.
Okay, so we'll get that news when it comes available.
Yeah. So that's what this is. So right now, what we're doing is we've taken samples that are in the US now, low grade and medium grade. I think we're aiming at sort of 0.4, 0.5 a gram and just under 1 gram. And effectively, we're going to rebuild those curves on that screen so we can see, okay, how long does it need to be in a tank? What recovery is it going to get at all these different grind sizes? And that's going to give us then a complete set of curves along with some of the others we've already got, just to do a reanalysis of the plant that we've got. And again, the one we've got now works fine. We're looking at, can we improve it? And so at this point, I know people out there are going to be asking, well, what are the results going to be? What are you going to come out with? It's hard to tell because we don't know, I haven't seen the results yet. But really what we're going to be looking at are, if the results are really extreme one way, you're looking at the situation where, okay, maybe we could go to that coarser grind instead of 105 micron, go to 150 micron. And then what happens is effectively you can go from 10,000 tons a day through the plant to nearly 12,000 through the same plant. You lose a little bit of residence time by going faster, but there's things you can do to tweak that and watch that. Or if you'd like, you could also shrink the plant down, save some capex, and go back to 10,000 ton a day through a smaller, cheaper plant. So you've got a few options to look at when you get the results out. That's if it's really obvious, the answer. There are a lot of other things you can see, like we saw that curve earlier with a high grade sample and the low strength cyanide not recovering all the gold in the right time. It might give us, start to give us data towards, okay, when you're mining Esperanza South, you need to run it as we've got it. But when you get to East and Central, low grade, you're going to dissolve the gold very quickly. Let's drop the cyanide recovery down, cyanide strength down, save yourself a lot of money, or keep the cyanide strength up and grind it coarser. You've just got those trade-offs you're going to do. But it's all optimizing and trying to improve it from here. And I think that's the real big question, the real factor here. We've got a really good base, but there's a lot of improvements that can still be made to it. And these are the tweaks on this. We will also be looking at, if we've got all the money to build it, $260 million, build the project, that is optimum. But if you're a small company trying to build it on your own, you might want to look at a soft start option where you get a gravity plant or something like that and step into it over a couple of years just to, not have to do that big spend right up front. So some of the test work we'll be doing, we'll be looking at that as well.
Now, what recovery are you going for? Obviously, closer to 100% is the best, but what's the bottom line that you could have?
Well, that's the what I'm trying to teach my team now is that, and maybe the message I want to get out to the investing world is, when you get to these fine tuning, you want to get away from thinking about recovery and just thinking about economics, because it's if you think about it as there's money in the ground, and we need to get it through this factory effectively and get as much money out as we can to our, to the benefit of our shareholders. You want to find out where the choke points are, which is stopping that money flowing through that plant. And if it means losing a bit of recovery, but you can make more money, the recovery is only one factor in the whole chain of events that make up the business plan. So I think there's a practical limit. I don't think you drop that recovery by more than 4 or 5%. But if you can put 20% more through the plant, lose 5% in recovery, and save yourself 25% in OPEX, it might make sense. That's the sort of trade-offs we're looking at doing. But so the other thing, once we get all these results, what we do is we sit down with the mining engineer and put all the new data in. So it's not just running it in these pits we've got now. We've got how will it change these pits? Will it give us more material, less material? Sometimes when you make these changes, you find, okay, we'll change the cutoff grade, and so a lot of things change, but it's that final economic number you're comparing against. So that's it. It's pretty simple. I hope this has given people a bit of an insight into it. How we look at these process plants and how we look at optimizing them. As we said, on March 15th, we're going to have the next webinar, which is going to be talking about the exploration targeting for our resource expansion, reserve expansion, and the new exploration zones. And that'll be interesting. So I recommend people come along, because it does talk about the plans and the targets that we've worked up with Goldspot over the last few months here now.
Okay. We'll save the exploration questions for that, but we can take a couple questions that have come in. One asked about supply chain challenges. Are you guys experiencing any issues with what I think we all understand? Everyone seems to be having supply chain issues.
Yeah, I mean, obviously we're not in production now, so we don't need that much on site. It's not really impacting us at this stage at all. Yeah, I mean, we had a lot of the challenges we saw in the pre-feasibility study were related to that, were how to get a good cost estimate. Because if we went to a supplier for mining trucks and they couldn't buy a mining truck because of supply chain, how can they give us a quote on one? We saw a lot of issues there, and that made doing the PFS really tough, doing the cost estimate part of it very tough. But apart from that, we don't see it. And obviously we've got another year and a bit now for our preliminary license. So I'm hoping that all of that goes away by the time we get our permits.
Okay, now let's talk about permits and what you need to still obtain to, let's say, get to a construction decision or even a construction start.
Yeah, so we'll be filing for our prior license in hopefully April, May. We've got all the information we need. So the PFS has supplied us all the information we need. And we would hope to get that by mid next year. It should have about 15 months from sort of now application time. And then after that, you file for your installation license, which would hopefully come pretty quickly after that. But that'll all happen in parallel with final feasibility and basic engineering. So I would hope that by sometime in 2020 or 2023, early 2024, you've got basic engineering complete and full permits in hand would be our target.
Okay, so that's maybe the earliest when people could expect construction to begin or that decision to be made.
Yeah. I think so. Yeah, and it's going to take for the feasibility and basic engineering is going to take that long anyway. So
yeah. Okay. In terms of this PFS, how does it compare to other PFS, either in the country, in Brazil, or any other projects that you are using as an analog for Castelo dos Sonhos?
Yeah, I can't share it probably for obvious reasons, but yeah, we track everything that comes out publicly by other companies. I noticed that Amarillo Gold published a technical report today, and that is now being up. So their data that we track is being updated as a comparison against ours, and it comes in pretty well. I mean, G-Mine, if we're talking to Zinho, published some data on a pre-feasibility study recently. We've got side-by-side comparisons of all of that. and it sort of comes into people are publishing numbers sort of now over the last 12 months. We're very, very comparable to their numbers, and I haven't seen anything to alarm me. You know, when you compared against people who had published stuff in 2019-20, we looked very high because they hadn't got any impact from the COVID inflation. So yeah, we tracked that in a lot of detail, and I haven't seen anything to give me any concerns at this point of time.
Okay. How deep was the drilling that was incorporated into this PFS?
I think the deepest section of pit's probably about 130 meters deep, something like that. So, you know, you're talking about 150, 160 meter deep holes to go through that, you know, because we can't project down below our drill holes by the rules we apply for our classification. You know, I think the deepest hole on site is about 500 meters deep, but that's probably away from the resource area. But in general, we draw to 120 meters vertical depth. A couple of spots where we know we've got good grade going deeper, we'll take 140, 100, and maybe down to 160 meters. But that's about the deepest we drill these days, because it's, you know, we've got such a lot of strike length where it's coming shallow. It's, you know, your high margin material is always going to be shallower than the deep stuff.
Mm-hmm. Now, there were a couple of questions, and we can have more of a discussion on this, but involving the M&A environment broadly for juniors, but then also in Brazil, because this fine tuning with the PFS and some of these optimization techniques, we could expect also potential acquirers to do that kind of work. What can you tell us in terms of general interest, potentially, of an acquirer of this project? Yeah,
well, I mean, it's, you know, we've been very open that we don't have a mine operating team. You know, we are a mine development team. That's what, when I took over the company in January 2016, that was our plan, to come in and develop this through to a production decision. It's gone really well. I expected to see a lot of M&A in the sector, in the region, over the last few years. We hadn't seen it then, but I think we're starting to see it now. The two companies I mentioned earlier who filed technical reports, G Mining bought Tocantinzinho from Eldorado. Hochschild's are in the process of buying Amarillo Gold right now. And there's been a few other transactions as well. You know, so I think it's been fairly active, and it'll continue to be that way. Brazil is probably one of the best jurisdictions right now for mining in South America. And historically, that was Chile and Peru, but those two countries have got some issues politically these days. And Brazil is still going ahead really well. So I do expect to see more M&A activity in the sector. And if someone wants to talk to us, we're always happy to chat, for sure. And but we are really, really well positioned now, having a deposit in a great location for permitting, a great location for building a mine, and there are very few multi-million ounce deposits like this around.
Now, regarding that statement, any other assets that are within the general vicinity of this project where there could be synergies between?
Not at a project level, no. I mean, there's nothing with, I think, closest deposit that I know about would be Sarabi's Coringa, is being developed about 75 kilometers north of us. So there's nothing where you can sort of share equipment and stuff like that. But, you know, administration in country is where you get the synergies, and you know, high level staff, you know, running the country. So, you know, you want to look who's in the state and who's in the whole of Brazil. So that would be where the synergy comes from.
Okay. But generally, you are seeing some of the bigger players, the bigger miners in the country still, right? They are active, and there have been a couple deals.
Absolutely, yeah. No, you're seeing, you know, I mean, the big guys are still there, and you know, and they're looking around, and there are very few deposits for them to look at.
Okay. Now, before we wrap this up, just give us a little insight on the next webinar coming March 15th, more exploration. What can people expect in terms of the exploration upside from the company?
Yeah, what we'll be discussing, you know, we've been working with Goldspot a lot. You know, we haven't done any drilling recently because we were focused on the PFS and getting that permitting going. But we have got, you know, a drill plan from them that they like. Our geos have been evaluating it, tweaking it, changing it, getting it ready. So, you know, that's a little summary of some of it on the screen there now. So we'll be discussing that. And, you know, and the decision is, do you try and expand reserves, do you try and expand resources to grow the global resource number, or do we look for completely new areas? And obviously, if you had unlimited budget, you'd get 6 drawings out there and you'd be doing all of them. That probably won't be the case, that we'll have that much money available. So we'll be just talking about where we're thinking of going, how we're thinking of growing the deposit. But we'll touch on, where the areas of potential excitement for growth are.
Okay. Nick, we're at the half-hour point. This is as long as we wanted this to go. Thank you, everybody, for sending in those questions. We hope that you did find this valuable and insightful in terms of some of the optimization avenues that the company has for the PFS. If any of you have any follow-up questions, feel free to email me. My email is fleck@kereport.com. I will get Nick to address those, and we'll also be back with you all March 15th for that exploration targeting webinar. So, Nick, thank you for the time. Thank you for putting together this presentation, and we'll follow up on the back of more news and the next webinar in March.
Thank you very much, Corey.